You are watching the greatest magic trick in the history of human civilization. A trick that has been running for 100 years, and for the first time in a generation, the magician is running out of rabbits. And the audience is starting to smell the smoke coming from behind the curtain. It is Saturday, December 6th, 2025, and the money in your bank account does not exist in the way you think it does. You have been trained to believe that liquidity is like water flowing through a pipe, infinite and always available when you turn the tap. But in reality, liquidity is a confidence game, played with massive leverage, and when the confidence breaks, the water turns to ice, instantly freezing the entire plumbing of the global economy. Today, we are going to dismantle the single biggest lie in finance, which is that banks lend out the money you deposit. They do not. They never have. They create money out of thin air every time they issue a loan via a double-entry accounting ledger expansion. And right now, that creation engine has thrown a rod. We are seeing a credit impulse collapse that signals a depression-level event is forming beneath the surface of the stock market highs, which are being propped up by a narrow group of companies, while the real banking system rots from the inside out. Welcome to the deepest investigation we have ever done into the mechanics of liquidity creation and destruction. Before we open the vault and expose the rusted gears of this machine, I need you to lock 3 doors in your mind. 3 specific mysteries that will explain why the next crash will be a dry crash, meaning no cash available at any price, regardless of what the Federal Reserve does. Door number 1. What is the collateral multiplier, and why does it mean that for every $1 of real, pristine money, there are $4 of ghost money supporting the system, creating a fragility that mathematics cannot fix?
Door number 2, who is the quote-unquote shadow treasurer that determines the global price of money. It is not Jerome Powell, and it is not the US Treasury. It is an algorithm sitting inside the risk departments of the G-SIBs. And door number 3. What is the velocity trap that makes $3 trillion of printed money feel like zero to the small business owner and the consumer? Keep those doors locked because we are going to kick them down one by one. Let us start with the cold, hard reality of the ledger and why the textbooks lied to you. Most people believe in the fractional reserve model, where you put $10 in and the bank keeps $1 in the vault and lends out 9. That model is obsolete. It is a fairy tale told in economics classes to keep you calm. In the modern financial system, banks practice credit creation. When you go to get a mortgage or a business line of credit, the bank does not check its vault to see if it has the cash. It simply types numbers into a computer. It expands its balance sheet. It creates an asset, the loan, and a liability, your deposit, simultaneously. Money is born from debt. It appears as if by magic. But here is the catch that is killing the system today. To create that debt, the bank needs balance sheet capacity. It needs regulatory space and capital buffers, specifically risk-weighted assets, or RWA, to hold that risk. And right now, because of the Basel III endgame rules, which fully kicked in this year, banks are shrinking their balance sheets. They are destroying money. I pulled the M2 money supply data for the last quarter and cross-referenced it with the H8 data from the Federal Reserve. It is contracting in real terms. When M2 falls, it means loans are being paid back or defaulted on faster than new loans are being created. This is deflationary death for an economy built on perpetual growth. It creates a vacuum where money simply vanishes from the system. Drop a comment right now. One word: saver or borrower. Which side of the equation are you on today? Let me know below, because the borrowers are about to get crushed by a machine that has stopped printing. Now, let us peel back the first layer of evidence, which is the repo market or repurchase agreement market. This is the real printing press. The repo market is a $60 trillion overnight pawn shop, where banks and hedge funds swap collateral, usually US Treasuries, for cash to fund their operations. This market determines if the financial system wakes up in the morning. If the repo market stops, the heart of the global economy stops beating. I am looking at the haircut data from the major clearing banks like Bank of New York Mellon and State Street. A haircut is the safety margin the bank takes. If you bring a $100 bond, they might lend you $98. That is a 2% haircut. But in the last 48 hours, we are seeing haircuts on corporate bonds and mortgage-backed securities widen aggressively. The banks are saying, "We do not trust your collateral anymore." When haircuts rise, liquidity vanishes. If a hedge fund was levered 10 to 1 and the haircut moves from 1% to 2%, they are effectively margin called on half their portfolio. They have to sell assets to raise cash to post the new margin. This selling lowers asset prices, which makes the collateral worth less, which increases the haircut even further. It is a liquidity death spiral, and it is self-reinforcing. And the Fed cannot fix this by cutting interest rates. You can lower the cost of money to zero, but if the bank demands a 50% haircut on the collateral, nobody can borrow. This is why the pivot is failing to stimulate the real economy. The transmission mechanism is broken at the collateral level.
You can understand this in 30 seconds. Imagine you have a credit card with a $10,000 limit, but the bank suddenly says they will only honor transactions if you put up your car as security, and they value your car at half its market price. Technically, you have credit, but practically, you are broke. That is the global banking system right now, paralyzed by a lack of trust in the underlying assets. But the problem goes deeper into the regulatory nightmare known as the Liquidity Coverage Ratio, or LCR. This is a rule born after 2008 that forces banks to hold high-quality liquid assets, or HQLA, to survive a 30-day stress scenario. It sounds safe, but it has created a hoarding effect. Because banks are terrified of falling below their LCR requirements, they are hoarding treasuries and refusing to lend them out in the repo market. This creates a shortage of collateral. It is a paradox. We have more debt than ever, but not enough pristine collateral to grease the wheels of the system. I spoke to a trader at a primary dealer desk who told me that the scarcity premium for specific treasury bills is skyrocketing. This means the market is desperate for safety. And when the market is desperate for safety, it means they are preparing for a crash in risk assets. Now let us look at the euro-dollar system. This is the dark matter of finance. Eurodollars are simply US dollars held in banks outside the United States in places like London, Singapore, and the Cayman Islands. They are not under the jurisdiction of the Fed. This is where the real global liquidity is created. For decades, European and Asian banks created trillions of these offshore dollars to fund global trade via FX swaps. But as the US dollar strengthens and US sanctions become more aggressive, foreign banks are afraid to create these dollars. The euro-dollar printer is jamming. This creates a dollar shortage globally. I tracked the cross-currency basis swaps for the yen and the euro.
They are showing severe stress. Foreign banks are paying a massive premium just to get their hands on dollars to service their dollar-denominated debt. When there are not enough dollars globally, emerging markets default and supply chains freeze. We are seeing ships sitting in ports because the letters of credit, usually denominated in dollars, cannot be issued. The blood flow of trade is clotting. And here is the rehypothecation anomaly. This is the dirtiest secret on Wall Street and the primary engine of the ghost leverage. When a hedge fund pledges a bond as collateral to a prime broker, the bank does not just put it in a safe. The bank lends that same bond to another bank to get cash. That second bank lends it to a third bank. This is called rehypothecation. The same bond is backing 3 or 4 different loans simultaneously. This creates ghost liquidity. It looks like there is plenty of collateral, but it is just one bond moving fast. The collateral multiplier is historically around 3 or 4, but I am seeing internal data suggesting that the multiplier is collapsing. Banks are hoarding collateral. They are refusing to relend it because they are scared of counterparty risk. When the multiplier drops from 3 to 2, roughly 30% of the liquidity in the system evaporates instantly, without a single dollar actually leaving. It is a contraction of trust.
And this leads us to the skeptic corner. You might say, but the Fed has the standing repo facility and the discount window. They can just inject cash whenever they want. That is the standard defense from the mainstream analysts. But here is the clue that destroys it: the stigma. I spoke to 3 bank treasurers this week off the record. They are terrified to touch the Fed's discount window. If a bank borrows from the Fed, it becomes public information. The market sees this as a sign of weakness. Shareholders panic. Depositors flee.
It is the kiss of death. So even though the facility exists, nobody uses it until they are already dead. We saw this with Silicon Valley Bank and First Republic. They waited too long because they feared the stigma. The safety net is made of spider webs. The psychological barrier is stronger than the mechanical availability. And let us not forget the deposit beta. This is the metric that tracks how fast banks raise interest rates on deposits when the Fed hikes. For the first time in history, deposit beta has hit 100% for large corporate clients. This means banks are paying 5% for deposits, but they are stuck with legacy loans yielding 3%. This is negative carry. The banks are bleeding money every day just to keep their deposits. This destroys their capital base, which forces them to lend even less. It is a vicious cycle of contraction. The more they pay for deposits, the less they can lend to the economy. This is why your local bank branch is closing and why getting a small business loan feels impossible. The capital is being consumed by the cost of liabilities. And this brings us to the reverse repo drain. For 2 years, the reverse repo facility was a slush fund of excess cash. It is now empty. The buffer is gone. Every new dollar of Treasury issuance is now extracting liquidity directly from bank reserves. This is a zero-sum game. The U.S. Treasury, led by Janet Yellen, is competing with the private sector for the same pool of dollars. And the Treasury always wins because they make the rules and they pay the risk-free rate. This crowding out effect means that small businesses cannot get loans. I pulled the Senior Loan Officer Opinion Survey, or SLOOS, from the Federal Reserve. The rejection rate for small business loans has hit a record high. The banks are saying, "We have no liquidity for you because we have to fund the government's $2 trillion deficit." This is how you get a recession with a rising stock market. The liquidity is trapped at the top and starving the bottom. And this brings us to the concept of velocity. Liquidity is not just the amount of money, it is how fast it moves. In 2021, money moved fast. You spent it, businesses spent it. Now money is sticky. It is sitting in money market funds earning 4%. It is sitting in corporate treasuries hoarding cash for the maturity wall. When velocity drops to zero, you can print $10 trillion and it won't create inflation. It will just create asset bubbles, while the real economy enters deflation. We are in a liquidity trap. The Fed is pushing on a string, and the banks are the ones cutting the string. They are de-risking. They are shedding assets. They are firing traders. They are preparing for a storm. And the storm is the unrealized loss reckoning. We know about the bond losses from 2023, but now the losses are in the loan book, specifically commercial real estate and private credit. A bank cannot create new liquidity when it is insolvent on a mark-to-market basis. It goes into zombie mode. It exists, but it does not function. It collects payments but makes no new loans. We have over 500 banks in the US right now that are effectively zombies. They are the clog in the pipe. The water is stuck behind them, and the pressure is building. The trigger for the break is not a headline event. It is a mechanical limit known as the settlement failure threshold, where the plumbing simply backs up sewage into the clean water supply of the global financial markets. I am watching the fails to deliver data in the US Treasury market, specifically the 10-year note. A fail happens when a bank agrees to sell a bond, but cannot find the bond to deliver by the deadline, which is now tighter than ever due to the T+1 settlement cycle implemented last year. Usually fails are rare, a rounding error. Right now, fails are spiking to levels we haven't seen since March 2020. This means the gears of the machine are grinding metal on metal. The lubrication is gone. When fails rise, it implies that there is a structural shortage of specific collateral.
Banks are scrambling to find bonds to cover their shorts, and they cannot find them because the HQLA hoarding we discussed is draining the float. This creates a squeeze in the repo market, where the cost to borrow a specific bond goes negative. Yes, you heard that right, negative. People are paying to lend cash just to get their hands on the collateral. This is the financial equivalent of a heart arrhythmia. And this leads us to the digital bank run risk, which is the sword hanging over every regional bank in America. In the old days, a bank run meant standing in line in the rain, and the bank could simply lock the doors at 5 p.m. to stop the bleeding. Today, a bank run happens via API. $1 billion can leave a bank in 1 second. The speed of money has exceeded the speed of regulation. The banks know this. That is why they are hoarding cash. They know that if a rumor starts on social media or a short seller report drops, they could be drained before their risk managers finish lunch. This fear forces them to stop lending. Why lend money for 30 years for a mortgage when you might need that cash in 30 seconds to survive a tweet? The duration mismatch is killing the lending market. I analyzed the uninsured deposit levels of the top 50 regional banks. Despite the warnings after Silicon Valley Bank, many still have 40% of their deposits uninsured. These are corporate payroll accounts. If these corporate treasurers use AI-driven cash management tools, which many now do, the AI will move that cash automatically the moment the bank's credit default swap spread widens. We have moved from human panic to algorithmic panic. The algorithms do not sleep, and they do not have loyalty.
And this leads us to door number 2, the shadow treasurer. You think Jerome Powell decides the interest rate, but he only decides the overnight rate for banks. The real price of money for the global economy is determined by the risk committees of the 8 global systemically important banks, or G-SIBs. These are the unelected bureaucrats inside JP Morgan, Citi, Goldman Sachs, and others who set the margin requirements for the rest of the world. When they get scared, they raise margin requirements. This effectively raises the cost of capital for everyone from hedge funds to factories, regardless of what the Fed does. Right now, these committees are in defensive mode. They are raising margins. They are the shadow treasurers, and they are tightening financial conditions aggressively. I have sources telling me that initial margin requirements for hedge funds trading credit derivatives have jumped 20% in the last month. This is a stealth tightening. It forces funds to deleverage. When a fund deleverages, it sells assets. When it sells assets, prices fall. When prices fall, the risk committee raises margins again. It is the VAR shock loop. Value at risk, or VAR, is the model these banks use. When volatility rises, VAR rises, and the model automatically commands the bank to cut exposure. It is a robotic liquidation machine that no human can stop once it triggers. This is why your stocks are struggling to hold gains. The leverage underneath them is becoming more expensive by the hour. Now let us look at the ETF liquidity illusion. This is the trap waiting for the retail investor, and it is the epicenter of the next crisis. You own an ETF that tracks high-yield bonds or municipal debt. You can sell that ETF in 1 second on your phone. But the underlying bonds inside that ETF trade by appointment only. Some of them haven't traded in weeks. In a normal market, authorized participants, or APs, step in to keep the ETF price close to the net asset value of the bonds. They buy the bonds and create ETF shares, or vice versa. But I looked at the legal agreements for these APs. They are not legally obligated to step in. They only do it for profit. In a panic, when the bond market freezes and there are no bids for the underlying junk bonds, the APs will step away. They will go on strike. When they step away, the ETF price decouples from the assets. The ETF might trade at 80 cents, while the bonds are theoretically at 90. This is called a discount to NAV, and it can blow out to 10 or 20%. You think you have liquidity, but you actually have a liquidity mismatch. You are holding a hand grenade with the pin pulled, trusting that a computer algorithm will save you.
but the algorithms are programmed to turn off when volatility spikes. This is the liquidity ghost. It is there when you don't need it, and gone when you do. We are already seeing signs of this in the municipal bond market, where ETFs are trading at discounts not seen since the pandemic. The market is sniffing out the illiquidity. And this brings us to the basis trade, which is the nuclear reactor core of the shadow banking system. The basis trade is an arbitrage strategy used by the largest hedge funds in the world. They sell a treasury futures contract, which trades at a higher price, and they buy the actual cash treasury bond, which trades at a lower price. They pocket the tiny difference between the two. Because the difference is so small, maybe only a few pennies, they have to use leverage to make it worth their while. I am talking about 50-to-1 leverage. For every $1 of their own money, they borrow $50 from the repo market to buy bonds. This trade has grown to nearly $1 trillion in size. It creates a massive artificial demand for treasuries, which helps the US government fund its deficit. But here is the trap. The trade only works if the cost of borrowing cash in the repo market stays low and stable.
We just saw the repo rate spike. When the cost of borrowing rises, the profit margin of the trade vanishes. The hedge funds are then forced to unwind. This means they have to sell the cash bonds and buy back the futures. When you have $1 trillion of selling pressure hitting the bond market at once, yields explode higher. And as we proved in previous investigations, when yields explode, stocks crash. This is the hidden link between a boring arbitrage trade and your 401k. The regulators know this. The SEC has been trying to force these funds to clear their trades centrally, which would increase their costs and kill the trade. The funds are fighting back, but the market is already voting. They are deleveraging ahead of the rules. This pulls liquidity out of the system exactly when we need it most. And let us talk about the private credit contagion. We have $2 trillion of loans sitting in private funds that are not marked to market. These funds promise investors steady returns and low volatility, but the companies they lent to are the ones that banks rejected. These are the riskiest borrowers in America. As interest rates stay higher for longer, these companies are hitting the maturity wall. They need to refinance. But nobody will lend to them, so they default. But the private credit funds do not want to show a default, so they engage in payment in kind, or PIK loans, where they let the borrower pay interest with more debt. It is extend and pretend on an industrial scale. I found data showing that PIK income now makes up 20% of the revenue for some major business development companies. This is phantom income. It is cash that does not exist. When the investors in these funds try to get their money out, they will find the gates are locked. We have already seen major players limit withdrawals. This turns a liquidity problem into a solvency problem. If you cannot get your money out, is it really your money? Drop a comment below, yes or no. Would you keep your money in a fund that limits withdrawals? Let me know. And finally, we have to look at the central clearing parties, or CCPs. These are the entities that stand between buyers and sellers to guarantee trades. If a major member fails, the CCP has to absorb the loss. I looked at the default fund levels of the major clearinghouses. They are woefully undercapitalized for a systemic event. If a major hedge fund fails and blows through its margin, the CCP calls on the other members to put up cash. This spreads the contagion instantly to healthy firms. It is a mutualized suicide pact. The regulators have pushed everything into CCPs to make the system safer, but they actually just concentrated the risk into a single point of failure. If the CCP wobbles, the Fed has to print. There is no other option. But printing takes time, and markets crash in milliseconds. The gap between the crash and the rescue is where your portfolio dies. This plumbing is so complex and so interlinked that no single regulator sees the whole picture. The Fed sees the banks, the SEC sees the funds, the CFTC sees the derivatives, but nobody sees the whole map, and the map is burning. The friction in the system is generating heat, and the thermometer is breaking. We are seeing volatility dispersion, where individual stocks move 10% a day on no news. This is the sign of a fragile market,
where liquidity providers are stepping away. They are widening their bid-ask spreads. In a liquid market, the spread is a penny. In an illiquid market, the spread is $1. When the spread widens, price discovery breaks. And when price discovery breaks, panic begins. This leads us directly to the breakdown of the correlation models. Every risk model on Wall Street assumes that bonds hedge stocks. But in a liquidity crisis, correlations go to 1. Everything gets sold to raise cash. Gold, Bitcoin, bonds, stocks.
They all fall together. This is the nightmare scenario for the quote-unquote risk parity funds that manage trillions of dollars. If bonds fall with stocks, they have to sell everything to delever. This creates a fire sale dynamic. And who is the buyer in a fire sale? It used to be the banks, but as we established in part 1, the banks are zombies. They cannot buy. So prices have to fall until they become attractive to the only buyers left, which are the distressed debt vultures and the sovereign wealth funds. This transfer of wealth from the impatient to the patient is the defining feature of a liquidity crisis, and we are on the verge of the biggest transfer in history. The setup is complete, the triggers are armed, and the doors are about to open to reveal the final truth about your money. Now, let us unlock the 3 doors so there is zero ambiguity left in the room regarding the fate of your capital. Door number 1, the collateral multiplier. It is the measure of how many times a single dollar of safety is leveraged across the global system. We established that it has collapsed from 4 to 2. But what does that actually mean for the price of assets? It means the global financial system is deleveraging by force. It is shrinking. When the system shrinks, asset prices must fall to match the smaller pool of money available to buy them. It is mathematical gravity. If there is half as much credit available, then the house, the stock, and the bond must eventually trade at half the price, or the leverage must be wiped out through bankruptcy. There is no third option. The quote, soft landing narrative assumes that the multiplier stays constant. It is not. It is crashing. Door number 2, the shadow treasurer. It is the risk managers at the G-SIBs, the global systemically important banks. They are voting no on the global economy. They are pulling back lines of credit to emerging markets, to hedge funds, and to small businesses. They are causing the dollar shortage because they are hoarding dollars to protect their own fortress balance sheets. They are the ones demanding higher margins. They are the ones cutting limits. And they do not answer to the president or the Congress. They answer to the VAR model. And right now the model says, sell. And door number 3, the velocity trap. It is the hoarding behavior that creates a deflationary spiral, even while inflation headlines persist. When everyone holds cash because they are scared, the effective money supply collapses. The Fed is printing billions, but the market is deleting trillions through risk aversion. It is like pouring water into a bucket with a hole in the bottom. The Fed controls the tap, but the fear controls the hole. And right now the hole is bigger than the tap. And finally, the master key. The master key to understanding liquidity is simple. Liquidity is not a stock, it is a flow. It does not matter how much money is sitting in the system. It matters if it is moving. Right now, the flow has stopped because trust has stopped. Banks do not trust each other's collateral. Lenders do not trust borrowers' cash flow. Investors do not trust the Fed's narrative. When trust evaporates, liquidity freezes. The ice age is here. This is the Minsky moment, where the stability of the last decade has bred the instability of today. So what is the actionable play for December 2025 and beyond? How do you survive a liquidity freeze? First, you must understand the hierarchy of money. In a boom, everything is money. Crypto is money. Stocks are money. Real estate is money. In a bust, only money is money. And the only true money in the current system is the US dollar and gold. Everything else is credit. You must move up the hierarchy. You want to hold assets that have no counterparty risk. Gold is the ultimate example. It is not someone else's liability. It is an asset that exists outside the banking system.
Central banks are buying gold at record rates because they know the credit system is breaking. You should follow them. Second, you must eliminate variable rate debt. If you have a floating rate loan, you are exposed to the liquidity crunch. If the repo rate spikes, your interest rate spikes. Pay it off or fix it. Do not be at the mercy of the shadow treasurer. Third, cash is not trash in a deflationary crash. Cash is a call option on every asset class at a distressed price. When the liquidation happens and the hedge funds are forced to sell quality assets for pennies on the dollar, cash becomes the most valuable asset in the world because it buys the wreckage. You want to be the one buying the Ferrari from the bankrupt crypto bro for 20 cents on the dollar. To do that, you need liquidity when nobody else has it. And fourth, watch the gate announcements. When the big private equity giants announce they are limiting withdrawals for the second quarter in a row, that is the bell ringing. That is them telling you the liquidity is gone. Do not listen to the press release, listen to the terms and conditions. The financial system has built a magnificent skyscraper on a foundation of quicksand. The engineers are telling us it is solid, but the geologists are packing their bags. I am watching the repo rate every single morning, specifically the SOFR rate. If it spikes overnight by more than 5 basis points without a Fed hike, that is the heart attack. That is the signal that the collateral is rejected. I am also watching the high-yield credit spreads. If the difference between junk bonds and treasuries blows out above 500 basis points, the game is over. That means the defaults have begun. And finally, the inter-creditor conflict. Watch the court cases. When lenders start suing each other to steal assets, it means there is not enough value left for everyone. We are seeing this now in cases like Dish Network and others. It is a war of all against all.
This is the end of the gentleman's agreement in finance. The gloves are off.
The survival guide is simple. Self-custody, hard assets, zero debt, and extreme skepticism. The pivot will come, but it will not be a celebration. It will be a rescue operation for the bond market, and by the time it happens, the stock market will have already repriced to reality. We are entering a period of price discovery that will be brutal for the unprepared, but profitable for those who understand that the rules of the last 40 years have been rewritten. The era of easy money is dead. The era of hard choices is here. I will be tracking the fails to deliver numbers next week. If they cross the 5% threshold, I will issue the emergency signal. Stay liquid, stay skeptical, and remember that money is just a ledger entry until you try to spend it. End of transmission.